Yeah, Karen, I think it is justified on the basis that, broadly speaking, if you're going into a rate-cutting cycle, and we've already seen that starting in most places and very soon in the US, and you avoid a recession, and that would be our central view, that tends to be a pretty benign environment for risk assets and stocks. And of course, they'd had quite a sharp correction on the back of last month's payrolls, on worries that maybe the economy was losing momentum, but the data since then has been more supportive. So I think that combination is broadly a positive one for stocks, notwithstanding the fact that, of course, you've got pretty high valuations.
Peter, as to where to be focused after what you called summertime blues, and slightly more than blues at one point, it was sort of wild action, I think, that we saw during the summertime, but it did flush out some trades, some of that in technology as well. What do you see now in terms of positioning? Is it best to go after some of those big cap tech stocks or to rotate, which we've seen in the last number of sessions, a little bit of rotation to small cap universe?
Yeah, I think what we're likely to see, and we've already begun to see this, is a bit of a broadening out. In that sense, the correction, I think, was quite healthy. You have to bear in mind that, the rally really leading up to that correction started last October and had taken global equities up around 30%, the Nasdaq about 60%, and many of the big tech stocks even more than that. So some flushing out of the concentration, particularly in the US market, I think has been healthy. And we have started to see a bit of a broadening out into more interest rate sensitive parts of the market, not just in the US but elsewhere. And I suspect that will continue. So for us, we like a kind of barbell really between some quality growth, including tech, but also some of the deeper value areas of the markets that could benefit from lower rates, but are actually now generating some pretty good cash flows and dividend growth.
Peter, really lovely to see you this morning. Sorry I couldn't come over the road to see you in person and get those free Goldman's canapes. But in all honesty, the exercise that Karen was talking about in early August when she was on set was another one of those market searching for pain exercise. Oh, my goodness me. The pain was just delayed after all, and we are going into a recession. For 2 years now, this market's been trying to say interest rates are so high, ergo there must be some pain. And not just the market, it's also the FOMC and everyone else. Everyone's been surprised that actually the economy has weathered the storm so well. But my question for you and for the economics and the markets, is there still pain to come? And actually, it was a prelude to a storm, to quote Churchill, that we saw in early August.
Well, I think the critical point here really, as you say, Steve, is whether or not there is a risk of recession. I think that was the proximate trigger. Of course, there were other things happening as well at the same time, the unwinding of the carry trade in Japan. But it was the weaker labour market data that really started to spook investors, because it's really been the consumer that's carried this economy through the period of rising rates. So this week is going to be critical because it will confirm one way or another whether the US labour market really is weakening. We think the data will be stronger, and that will confirm that the probability of a soft landing still remains the most likely. Our economists expect the probability of a recession in the US over the next year to be about 20%, slightly higher than the unconditional average. If that is true, and we continue to get rates coming down because inflation is not the problem it was, that, I think, does provide the basis for a broadening out of equity returns and moderate but positive returns, and outperforming other asset classes through the course of the next few months.